Hello, everybody. This is Paul Hirschenberg with Hirschenberg Financial and Employee Benefits.
And Brad Hughes with Southwest Wealth Advisory Group.
We are here today to go through our June and July investor update. And before we begin, we have a disclosure notice we have to read.
Hello, everyone. Thank you for joining us today. Before we get started, we do have a couple housekeeping items we have to take care of. This call is being recorded, and this call is brought to you by Hirschenberg Financial and Southwest Wealth Advisory Group, located at 2131 East Broadway Road, Suite 29, Tempe, Arizona 85282, and 426 North 44th Street, Suite 115, Phoenix, Arizona 85008, respectively. Our phone numbers are 602-321-2889 and 602-931-4456, respectively. Securities and investment advisory services offered through Woodbury Financial Services, Inc., member FINRA, SIPC. Woodbury Financial Services, Inc. is a separately owned and other entities and/or marketing names, products, or services referenced here are independent of Woodbury Financial Services, Inc.
All right. Thank you very much. As everybody knows, these last few months have been a challenge from an investment standpoint. And I think the main thing that we like to let everybody know is what our plan is going forward. And that's what this is going to be about, is what is our plan moving forward. So having said that, I'm going to turn it over to Brad. Brad, go ahead and take over.
Okay. So markets peaked in February. That's when COVID kind of came into focus here in the United States. We had a very sharp decline. They bottomed probably, I think, a lot quicker than people thought they would in late March. And we've had a recovery in stocks since that time frame. We have not had an economic recovery, but we've had a recovery in stocks. So there's been a decoupling of those two. We're right now in an environment where money markets or cash are paying us 0 or very close to 0%. 10-year treasuries are very low as well, around 0.7%, meaning if you invested $10,000 today in a 10-year treasury, in 10 years, you would get back roughly $10,725. Because of that, we do think that for those people that have cash on the sidelines, stocks are likely the only asset class that will provide a respectable return and allow people to keep pace with inflation. Perfect.
And as we go through this, guys, every one of our clients is different, and you guys all have different needs. So, what might apply to one of you might not apply to the other one. We will be talking to each one of you individually to go through these ideas on a one-on-one basis and to get your feedback. Sorry about that, Brad. Go ahead and take back over.
No, absolutely. So the thought is to utilize the cash that's on the sidelines in your account and put it to work over time. Dollar cost average back into the market, either a third or a quarter at a time. And in those cases where we have discretion on your accounts, it's a discretionary account with Woodbury, we would put that to work as we see fit. For those of you who do not have discretion, as Paul mentioned, we would reach out one-on-one. And I think it's also critical to remind you that these are tailored to your individual situation. They're not cookie cutter strategies. To reiterate, we think that stocks have much more upside potential than bonds or cash. And the biggest reason, because interest rates are so low. Is it too late or too early to get back in? You can make a case for both. But I think the biggest tailwind we have is the amount of stimulus that has been generated and the likelihood that we're going to see more. Anytime we have, I shouldn't say anytime, most of the times when the Fed has taken action to the level that it has taken so far this year, stock markets tend to benefit from that. We also want to start having some of that reinvestment occur before a vaccine is discovered. We've seen in certain days there's been whispers of vaccines going to maybe a stage 3 trial, and markets have benefited from that. So it doesn't mean we want to have all of the dollars that are in cash invested before we get a vaccine, but we definitely want a portion of it so that investors can benefit from that. Because the likelihood is once we get to the point where a vaccine can be distributed en masse, markets should take off from that standpoint. The likelihood is we'll see volatility between now and the end of the year, but we still think it is worth taking on that volatility to have a portion of that cash dollar cost average back into the market over time.
So Brad, I guess the big question is what are we going to be putting that money into? And I know that you're going to cover that next.
Yeah, so we'll talk about that for sure. again, there's a delineation between those that have discretion and those that do not. But I think what we're looking at is the cash that's on the sidelines that will not be needed for the next, say, 3 years, because we do believe there's a 2 to 3 year runway here where stocks will outperform both cash and bonds solely because of where interest rates are and things of that nature. And again, we want to invest before there is clarity on a vaccine, not as it's being released or after the fact. Timing, again, we want to do it in stages, and reason for that, the amount of stimulus that the Fed has generated and the likelihood that we're going to see a vaccine, maybe not before the end of this year, but maybe early next year. And as you had asked, what does it make sense to invest in? We do believe a barbell approach is the right way to go. If we think about a barbell on one end with more conservative investment options and a barbell on the other with higher risk but more opportunistic investment options, those lower risk investment options would be things such as conservative stocks, asset allocation or balanced funds. There's even things called tactical allocation funds, but essentially balanced tactical allocation funds are a combination of stock and bond. The bond piece of it tends to reduce the risk of the stocks inside of that investment option, and it's still a better situation than just going outright and purchasing bonds today, purchasing them outright with where interest rates are. That higher risk, more opportunistic, U.S. large cap growth, and then really specific sectors in the economy such as online retail, financial technology, medical devices, cloud computing, next generation internet, and DNA technologies, which very well could have and likely will have some hand in creating the vaccine for COVID-19. Again, timing, we show 4 investments there on the slides. Taking those dollars that are on the sidelines and investing them in either 3 or 4 different times through dollar cost averaging, for those of you who have discretion, we would do that on your behalf. For those of you who do not, again, we would be reaching out to you. We would want to take advantage of 3 to 5% declines in stocks to be able to put those dollars to work, so that when you have a negative day, we can actually turn that into a positive situation. In summary, we do believe it makes sense to dollar cost average the cash that are in the accounts back into the market, where we have discretionary authority doing that on your behalf, where we do not reaching out to you individually, in 3 to 4 tranches at a time, barbelling those investments, 1/2 conservative, 1/2 higher risk, looking for those declines in in stocks of say 3 to 5%. And the reason we're looking at stocks as opposed to bonds is interest rates being as low as they are, the massive amounts of stimulus that the Federal Reserve has put forth, and the potential of additional stimulus going forward. And we also want to have some of those dollars invested before we see a vaccine or have clarity on a vaccine, so that we can participate in that upswing when it does occur.
And Brad, we're going to be starting this buyback in pretty much immediately. Is that correct?
It is. I mean, obviously, it's really hard to say when those downturn days are, but I think there are opportunities, and it's not even as simple as saying market's down 3%, so we put 1/3 of it back to work. We may even dial it into some of those individual investment options and pick those on the days when they're down the most.
Right. I think the last thing I really wanted to touch on today, and you kind of hit on a few times in the call, Brad, discretionary accounts versus non-discretionary accounts.
Absolutely.
Brad, would you mind just giving a quick definition of the two of those, and I'll jump back in?
Certainly. Historically, as you and I have worked together over the last almost 25 years, we've done everything non-discretionary. So in that instance, for us to make a change in a client's account, we have to reach out to that client individually, discuss what we're doing, receive their approval, and then make the change. That works fine in a normal market cycle. In a fast market cycle, trying to reach out to 1, 2, 3, 400 people or 300 client situations, it makes it very, very challenging, because somewhere you're kind of working your way down a list. You can't reach out to everybody simultaneously, and somewhere you run the risk of somebody getting forgotten. So in the discretionary situation, if a client is comfortable with it, we can make those changes on their behalf. It's the purpose of it is to make those changes in a fast-moving market. In instances of a normal market cycle, we would still go through the same review process. We would still make recommendations to if we saw changes that were necessary, and make those changes after we suggested them to them. But in those faster markets, like we had in February, March, and April, being able to either take risk off the table or put dollars to work when it's applicable in a discretionary manner can really be extremely beneficial to the client as long as they're comfortable with it. And I think it does generate some benefits for the client. It's so hard to look back in the past, but if we would have been able to say, if we knew that the market was going to bottom on March 23rd, which there's no way that we did, and we would have said, all right, let's put money to work on March 24th, we could have done that on a discretionary basis if we had that on these accounts.
Now, obviously, we are not that good usually, and it'd be hard for us to actually pick that bottom. But I think the real point there is it just lets us act with more speed. Now, we do know that some clients out there are more comfortable with a non-discretionary. They'd like to be more involved. They want to have some say in where their money is invested. For those type clients, once again, we are more than happy to keep that the way it is. This is just for those clients who we call all the time, and they say the same thing to us every time, which is, you're the advisor, do what you got to do, quit bothering me. and we always nicely say, well, we have to call you and let you know before we make the trades. So this is, long story short, this is just a way for us to act faster, and hopefully, that'll benefit everybody's account.
I think the other part that's critical about that is that they would still receive all of the same documentation they receive today. So if they're receiving confirmations of trades today, they would continue to receive those. All the activity would be on the statements. We wouldn't want to go to discretionary in an account relationship in an effort to create some level of secrecy. It is simply to be able to act faster on the client's behalf. And it's still a situation where once those trades are placed, the expectation is we would follow that up with an email saying, here's what we did, here's why we did it. Let me know if you have questions, and we can move forward. But it's never a situation where we want to create a shroud of secrecy. That's not the objective in it. It is really to ultimately benefit them and allow us to act in a quicker manner on their behalf.
Perfect. Well, guys, thank you all very much for listening. As we've said in the past, we plan on doing these on a monthly basis now, and I will be reaching out to everybody over the next probably 10 to 15 days to talk more specifically about the investment ideas that we ran through today and get your all's approval, and then obviously discuss the going to discretionary if you want to. So guys, once again, for behalf of Paul Hirschenberg and Brad Hughes, thank you guys very much. Have a great day, and we'll talk to you soon. Bye-bye.
Stay safe and stay opportunistic.